What's your take on, it's interesting because now everyone wants to go into passive investing, right? Big, large cap stocks, liquidity, large cap tech stocks, that's the rage, the FANGs. It is very similar or reminiscent to the Nifty 50s bubble in the 1960s, where essentially everyone crowded into these blue chip stocks. And those stocks, I want to get your opinion on that. And what's your view on that? And really, in terms of where do you see opportunity in the different market cap segments of value as well?
Every boom has this echo of other booms in the past. I think that, but there's always tech is always very sexy, whether it was electronics in the 60s, dotcoms in the 90s, and now it's software as a service.
Railroads.
That was a tech at one stage.
Yeah, it was a tech. Right. South Sea bubble, the colonies were a tech stock at the time, right?
People were worried about traveling on railroads because they thought that if you went faster than the speed of a horse, you'd be atomized, which is terrifying. But that's the sort of stuff. That's how technologically. That's the tech of the day. That's why it was so exciting for them at the time. The potential to be atomized, which probably there's a lot of value investors who'd like that right now. I think that every boom has some sort. You can draw analogies. They do look like other booms in the past, and I think that probably because they're driven by the same thing. There's some potential to invest in some life-changing or world-changing technology that seems to earn very high, maybe not very high profits, but seem to generate a lot of revenue or a lot of growth at least over a period of time. It looks like it's going to wash everything away that exists. I mean, that was the argument, the dot-com boom, right? These dot-coms are going to come in and they're going to wash away everything that's gone beforehand. Instead, what happens is all of the incumbents just adopt. If all you need to do is make a web page, or they just adopt those business practices, and the market goes back to the way that it was before, where everybody's competing pretty much on a level playing field, and that's a better period for value. The market seems to have, all of the performance in the market has been in those very large cap tech stocks, but they have been, the ones that have performed very well have been ones that generated they have actually generated some profits and some very good revenues through. So Amazon, Facebook, Apple, less so Netflix, but Netflix is still growing at a very high rate. Google, if I didn't mention Google, but they are very profitable. They are very good businesses for the most part. And I don't think that they're expensive, but they're not extremely expensive. I think that some of the real overvaluation, the really egregious overvaluation is in some of those other. I think Netflix is more of that egregious overvaluation. Tesla certainly very egregious overvaluation.
So you talked about this tech effect. This idea that people. I hear this all the time among a lot of millennials, where it's different this time. The valuation's different this time. We've had a transformative change in technology. The iPhones have changed, the smartphones have changed everything. This is a new era for technology, and yet value investing has survived through the ages. Can you talk a little bit about is this a new era? Is this different? Has it changed, or will we seek a reversion of the mean in the same framework?
There are some compelling arguments for why things may have changed. I don't know that this is the first time that this has happened, but there may be changes in the market. So there is some parallels between, in the 1920s, when cars were sort of introduced and everybody got access to a car. There was a period of time where roads were built out, infrastructure for cars had to be built out, and that was a very bad period to be a value investor and a very good period to be sort of a more tech growth type investor, with cars being the tech of the day. And that lasted for about 16 years, and then value investing returned and did very well, and has done pretty well through the whole period. So we may be looking at something like that, where it's just maybe it is a little change in the structure of the economy, or there's a change in the structure of the market. I don't think that it means that value will stop working. And I don't think that it necessarily means that change is a permanent change to the structure of the market. I just think that because the logic, I think, of value investing is so compelling. If you're buying something for less than it's worth, that should be recognised by the market over a period of time. Perhaps our definition of value has to change a little bit to keep up. So price to book value was the traditional metric for academics particularly. Some practitioners, maybe Walter Schloss was more of a book value investor, but I think that he did some other things on top of that as well. But he was more maybe like an early quant where he'd have quite a diversified portfolio of low price to book value stocks. He did very well employing that sort of strategy. I still think you can do very well employing that sort of strategy to the extent that there's underperformance now. It's pretty easily explained by the way that tech stocks are looking very sexy and they've run very well. A lot of investors look at the trajectory of the price only. So if something's gone up a lot, that's a reason to buy it because that means that it will continue to go up into the future. Whereas value investors take the view that you have to look at the opportunity and buy it at a discount to the opportunity. All of those companies that have those sort of ski jump price returns, they almost invariably come back to earth. Not all of them have come back to earth yet, so I can't say that they always do, but excluding the ones in the current crop, that's always been the case in the past. They get to that point where they're vertically ramped, there's nowhere else to go, the weight brings them back to earth. And so I think that that's likely to happen to certain stocks, and I think that that's the precipitating event that leads to value then having a very good period where we all come back to our senses a little bit and try and buy fundamentals and cash flows. And we remember that, the function of business is to provide a service, to provide a product, to provide some sort of consumer surplus, but also to reward the shareholders in those businesses for putting capital at risk.